In this week's video, we'll review the latest charts to help us answer the question, have stocks made their final low? We'll be moving quickly, so feel free to use the pause button on your video player. This slide here serves as a wildcard overlay for the remainder of the video. If you were following along on Friday, the monthly labor report was a gigantic miss. You would think, the market would think that'll keep the Fed on the sidelines, it'll help the bond market, interest rates will most likely fall, your leaders would be tech, growth, and the market itself. I think it's noteworthy. About an hour and 10 minutes after the horrible labor report was released, this article was published in the Wall Street Journal. Jobs report keeps Fed taper on track for November. If you read this blurb here and this blurb here, and if you watched the press conference from the last Fed meeting and listened to Powell's remarks, it's very, very possible that the Fed is starting to get concerned about inflation. Inflation is a big, big wild card to a lot of base case information. And the big yellow or red flag would be that if the Fed starts to talk about accelerating timelines, either an accelerated pace for their tapering and or an accelerated pace relative to the first rate hike. Inflation, rising interest rates could create a big shift in leadership in the market. Could alter our base case, especially in the short to intermediate term. And all of this is good because it helps us with that all-important maximum flexibility. And we handle this topic and these bullet points the same way we handle everything. We trade the charts and the data in front of us. We're not wedded to any story about inflation or any story about asset class leadership. Maximum flexibility on all topics 100% of the time. This is the maximum drawdown chart that we've covered in a previous video based on the 7 consecutive new highs that were made in the S&P 500. This chart is dated September 30th. And we'll talk about these concepts in more detail later in the video. In terms of Friday's session around 11:22 a.m., really not seeing anything that's particularly alarming relative to the magnitude of the drawdown thus far. In terms of putting in the final low, the S&P 500 has made some progress from this low here to this point here, but we really need to clear this downward sloping trend line and see some type of follow-through on this move here. Now let's talk a little bit about market leadership. We could show a lot of charts like this. This is FTech relative to SPY technology stocks relative to the S&P 500. This is the 200-day simple moving average in red. Have an uptrend here on the left side of the screen. We have a pullback from A to B. We retraced 61.8% of that pullback and recaptured the 200-day moving average, increasing the odds that this uptrend was about to resume. However, we're still holding and floating around the 50% retracement and haven't cleared this flattish-looking 200-day, nor have we exceeded this high up here. Most of these indecisive charts are based on interest rates. Right now, in its present form, this chart tends to lean towards tech over the S&P 500. Those odds would deteriorate if we moved into this area here. The longer we stayed there, the more relevant it would become. You can pause your video player here. From a valuation standpoint, some tech stocks are starting to look a little bit more attractive. A lot of cross currents here. Equal weight S&P 500 relative to the standard weight. Some improvement here, some give back here, but we're still in a longer term downtrend. Relative to which way this chart breaks, and really all of these charts in this segment, have a significant impact on asset class leadership. Having the ratio be sitting basically at the 200-day moving average tells us we're indecisive relative to the longer-term trend. Very, very similar concepts. Some improvement here, but also a lot of work to be done to flip this trend from a longer-term perspective. This is TLT relative to SPY. You can see we've been trending sideways in an indecisive manner looks like we're trying to break in favor of stocks and against bonds. You can see the long-term trend in red. The 200-day remains down against bonds and favoring stocks. In this week, we have a lot of breakouts on stock bond charts. You can see small caps underperforming TLT for several months in here, coming back to an upward sloping 200-day. Looks like they're trying to make a stand, and it looks like they're trying to break out on October 8th. The longer we stay in this region up here, the better it would be for small caps and stocks in general. Conversely, the longer we move into this area here, the worse it would be for the S&P 500, the stock market in general, and small caps. The takeaway for this week is we are seeing something right now that we haven't seen in several months. Similar situation here, RSP relative to TLT. Coming back to an upward sloping 200-day moving average and trying to break out in a bullish manner. Common theme here, lots of breakouts on stock bond charts. Got extended in the ratio from the 200-day moving average, consolidation. Looks like we're trying to resume the uptrend. As always, these comments are based on the look of the chart today. This is October 8th. The longer we stay above this line here, the better it is for the stock market. There's a reason why we have a term, failed breakouts. We would learn something if this fails and we move down into this area here. Right now, it's looking better for stocks relative to bonds. This is value divided by growth stocks going back all the way to 2009, 2010, left side of your screen. This is a big confused mess. Improvement above the 200-day, below the 200-day, and clearly still in a long-term downtrend. This growth versus the S&P 500 October 8th, we're above the 200-day moving average, but it's flattening out. Right now we're above the 61.8% retracement of this decline here. The longer we stay in this region here, the higher the odds that this uptrend resumes. You can see the indecisiveness here. How many of these ratios are near the 200-day moving average? Which way they break will impact asset allocations. A lot of good things are happening in energy. That's on a shorter term basis here, above a 200-day moving average. Here, we're clearly still in a long-term downtrend relative to the S&P 500. Spent a lot of time on this. Another indecisive look. This is the A to B decline here. We came back up to about the 50%, 61.8% on this rally and stalled. Haven't made a high in this ratio, financials relative to the S&P 500, since June. Some good things happening here where my cursor's moving around. Still in a long-term downtrend here where my cursor's moving around with work to do. Now let's shift gears to the bigger picture or a longer-term outlook. Last week we talked about the debt ceiling and this Plan B window here. This week we finally saw some movement on the issue on Wednesday, October 6th. The market reacted in a favorable manner. The S&P 500 peaked on September 2nd here and has had a rough few weeks. In this shorter-term context here, how do we monitor the secular trend thesis? Well, there are numerous ways to do that, and the model uses a weight of the evidence approach, but let's look at the S&P 500 and the 10-month moving average shown in blue. This is the strong move in the S&P 500 that began in 1995, and then the S&P 500 rolled over in the year 2000. You can see during the bear market, price stayed below a downward sloping 10-month moving average for the most part. We had one monthly close above the average here. Similar situation in the financial crisis bear market. You can see this look here, very, very similar to this strong downtrend here. This look here and this look here are in sharp contrast to a strong trend look relative to this look here, 1995 into 1998. Thus, all things being equal, relative to the 10-month moving average, It's easier to stay invested and ignore volatility when you're getting monthly closes above the 10-month moving average. Conversely, when you start to get closes below, especially a downward sloping 10-month moving average, it's much easier to justify taking defensive action. And as you can see here, price is below a downward sloping 10-month moving average in the relatively early stages of this bear market. And the same can be said here. And that works both ways. Observable evidence here in the relatively early stages of an incredibly strong trend. And if we zoom in on this period here, so now we're looking at 1995 here into 1998 on the right side of your screen. And during this entire period, all of 1995, all of 1996, all of 1997, and about halfway through 1998, we never have an S&P 500 close below the 10-month moving average. This is what an incredibly strong trend looks like. And notice, before this period, we had a period of indecisiveness back here, where we're above the 10-month moving average, we're below it, we're above it, we're below it, and then the strong trend eventually starts. This is your harder markets in here where my cursor's moving around are typically followed by easier markets. So how does all of this help us in the present day? If we take those same concepts and put them on a chart, 2018 to October 6, 2021, it's pretty easy to see. On the right side of your screen, we have a very strong trend. That's the chart in front of us on October 6th. And the important thing relative to this metric is a monthly close below the 10-month moving average or above the 10-month moving average. And like this period of indecisiveness here in the lower left-hand corner of your screen before this big move in 1995, 96, 97 into 1998, the extremely strong trend that we have in the present day was preceded by a relatively long period of indecisiveness. Above, below, close above, below, above, below, above, below, and now we're above. Here we get an indecisive slope in the moving average, flattish look, and here it starts to turn up in a bullish manner. 1994, a flattish look, and it starts to turn up in a bullish manner. And it's incredibly important to note, the purpose here is not to say the present day is like 1994. The purpose is to say we have a strong trend in the present day, similar to the 1994-1995 period. This period of indecisiveness here is a result of the net aggregate opinion of all market participants regarding all subjects on all time frames. The same can be said here. The same can be said in this indecisive area here and in this confident area here. This here, looking similar to this period here in 1995, doesn't mean the fundamentals, the combination of the fundamentals and the technicals in 1995 are identical to the combination of the fundamentals and technicals in the present day. It simply means the net aggregate opinion, the net result in 1995 and early in 1996 resulted in a very, very strong bullish trend. The same can be said for this period here. Doesn't mean monetary policy is the same. It doesn't mean interest rates are the same. It doesn't mean valuations are the same. It means the net result, the net interpretation is similar. And that's what really matters. When the net aggregate opinion is positive, we get bullish trends. When it's indecisive, we get indecisiveness on our charts. When the net aggregate opinion flips over bearish, we get downtrends. And notice none of this has anything to do with our personal opinion about any topic. It's the market's opinion on all topics on all time frames that determine price and ultimately determine the value of the investments in our account. And from a longer term perspective, we're asking ourselves, does the present day look more similar to this period here or this period here relative to this period here or this period here? And based on the chart in front of us today, what we have right here, it really doesn't look a lot like this. We have a lot of green in here. Not the case here. This looks like a dinosaur's back. This looks like a dinosaur's back. This strong trend looks similar to this strong trend and this period in here and this period in here. That doesn't mean that's what it's going to look like tomorrow. We make decisions based on the chart in front of us. And thus far, during the recent bout of volatility, we did not get a weekly close below the 10-month moving average in September, and we haven't even dropped below it intra-month thus far in October. And that doesn't mean we're predicting that it won't happen, but it hasn't happened yet. And if it does happen, we'll learn something. And if it happens for 2 months in a row, we'll learn something. If it happens for 3 months in a row, we'll learn something. And all of it speaks to probabilities. Remember in last week's video, we looked at the present-day S&P 500 in the center of the screen. We looked at a chart as of September 28th. That was 26 calendar days after the S&P 500 peaked. And last week, we looked at all of these periods 26 days after a peak. And every one of these periods showed an 8-month period on the chart. If we fast forward on all of these charts, and now we're looking at 33 calendar days after the peak, and that would be October 5th of 2021, relative to the peak in early September. The same can be said for this point here. This is 33 calendar days after this peak. So how does a 2021 chart compare, and what can we learn? And more importantly, what could we learn when the market was falling, when things weren't going particularly well? So now we have all the charts 33 days after the peak showing roughly an 8-month period with the same moving averages. If we compare the present-day chart in the center of your screen, it's pretty easy to see 33 calendar days after the peak, the net aggregate opinion of all market participants regarding all subjects pushed the market well below all of the moving averages. Not the case in the present day, and that tells us something about the interpretation of all the fundamentals and all the technical data on all time frames as of October 5th. It's quite a bit better than this look here. It's quite a bit better than this look here. 33 days after the peak in 2018, we had dropped below all of the moving averages on 2 occasions. Not even close to the bottom here, looking at the same period. This here looks a lot better than this. All of it's relevant. This back here is foreshadowing the problems in the future. Similar situation here. The market peaks in October of 2007, but before that, we're below all of the moving averages. This tells us market participants are concerned about something in here. And ultimately, these concerns proved to be accurate, and the market did roll over in October of 2007. Moral of the story here is this looks a lot better than this period, this period, this period, and this period, 33 days after the peak and over an 8-month look-back period. And notice the volatility in here, for the most part, occurs above an upward-sloping 50-day moving average. And the amplitude of the volatility is relatively muted. Compare this look here to these wild swings here. Again, this is indecisiveness. And usually when indecisiveness ends, you either get a break in this direction or in this direction. In this case, we eventually fell all the way into early 2016, February of 2016. So how was this helpful on October 5th? And really, since the market's been falling, it's basically been telling us that the present-day trend looks quite a bit better than all of these periods at a similar point after the peak, maybe with the exception of 2004. And that's noteworthy because 2004 had the most muted drawdown. This is the maximum drawdown in 2004. It was 8.16%, quite a bit tamer than the other cases. And as we said last week, the more the present-day chart morphs into something like this, or this, the more concerned we would become. We're allocated based on the chart in front of us. We're not making any predictions about what the chart's going to look like tomorrow other than assessing probabilities. Let's shift back to the 2004 case, upper left-hand corner of your screen, and this was our drawdown. Remember last week we covered the maximum drawdowns for the cases where the S&P 500 was up 15% or more at the end of August. These were the maximum drawdowns in those historical cases. What would an 8.16% drawdown look like from this peak here in 2021? How does it compare to the drawdowns that we've already covered relative to previous studies? It's very, very similar. An 8.16% decline would take us right down to that June low that we've been talking about for several months. All of this basically tells us any pullback into this general area here or to these lines tell us that for the most part we're staying on the historical script. And why is that relevant? Because in every one of these cases in this study, with the exception of 1987, good things happened after this pullback. These were the maximum drawdowns. And then the market moved higher. Now let's shift gears back to that 10-month moving average chart. This is the S&P 500 monthly on October 6th. The 10-month moving average is 4177. Also noteworthy, look where the strong trend starts. This article was dated April 28th, and it speaks to demographics in this period here. After the millennials overtake the baby boomers as America's largest generation, which means every day that goes by, the economy is being driven more by the younger millennials and less by the older baby boomers. You can see that for the most part coincides with the early stages of this strong trend. This just happened to be dated April 28th, talking about data in this window here. The S&P 500 bottomed about a month earlier in March of 2020. Now we said all things being equal from a probability perspective, we would prefer to see the S&P 500 hold 4177 or remain above the 10-month moving average at the end of the month. If we put 4177 on this maximum drawdown chart, it also comes in right around the June low. Once again telling us we have data and concepts in the present day that allow this general area in here to be a reference point. And you can see thus far on October 6th, we're holding above this general area, and we seem to be in the 100% normal and to be expected drawdown range relative to the historical cases that are tied to the present day based on something that happened recently in the present day. And as you might imagine, as the market is falling, investors are becoming more and more pessimistic. You can pause your video player here. See this reading here? The last time it was this high, the S&P 500 in blue bottomed soon thereafter. Here's where we are today. Here's where we were here. The S&P in blue bottomed soon thereafter. And even if you want to use this spike, bottoms soon thereafter. When sentiment starts to get near extremes, it starts to become more useful. Nothing definitive here. It just tells you to keep an open mind about the market reversing in a bullish manner sometime in the coming days or weeks. As we walk forward here, what we're trying to figure out is when the market's been weak recently in this area here, are we seeing evidence that tells us we have something that contradicts the secular trend thesis? Do we have something in hand that says this bullish trend looks like it's about to roll over? So this long-term bullish trend here, do we have evidence that something like this could be happening or something like this could be happening? Well, we know this with 100% certainty. If the long-term trend is going to flip from bullish to bearish, then the shortest-term trends have to flip from bullish to bearish first, and that's what this chart helps us with. This most recent A to B move, the low in May to the peak in September. Here, at the weekly low, the intra-week low, we were still hanging right around the 50% retracement of this move, just from May to September. And then by October 5th, you can see we're trading here. We're above the 38.2, the 50, and the 61.8% retracement. And even at the weekly low, we were well within these normal fibs. And if we're above this retracement, the same can be said for this move. You want to take the move from the March low to the September high. We came back here. We came back roughly to the 38.2. In this case, it was the 50. And if you want to go all the way back to this September trend that starts in this area here, this would be your point A, and this would be your point B. The low thus far this week is well above that 38.2% retracement. Once again, we're not predicting that it's going to hold. It's just saying when we hit the low earlier this week, there was really nothing particularly alarming here telling us that even these shorter-term trends were in jeopardy, much less this longer-term trend off the low. If we move into these areas here, below all of these fibs, below all of these fibs, and below all of these fibs, which would take us below the June low in this case, we would learn something. They're all just probabilistic reference points. If we're trading the chart in front of us this week, as of October 5th at 3:04 p.m., it just didn't look that bad. We held here. We held here, and we held in a similar place thus far. All of these can help from a bullish perspective, and they can also help assessing increasing bearish probabilities if these areas don't hold. This was the look on October 5th. If we go forward to October 7th and add a simple 200-day moving average, we can also see this pullback, we're still above an upward sloping 200-day moving average. Another reference point relative to a bullish trend. Very, very similar concepts for growth relative to the fibs, the retracements, and the trends. Can also add in RSI. Market made a stand here in May, made a stand here in March, made a stand here in November, made a stand here in September. So basically, during the entire rally, daily RSI, for the most part, when it comes backwards, holds somewhere in this general area. As of October 7th, at the close, we were holding in a similar area. If we move into this area here, it doesn't mean it's the end of the world. It just speaks to increasing bearish probabilities. The same thing can be said for every level on here. If you move into this area here, the longer you stay there, the more concerned we would be. Very similar concepts for the S&P 500 with one caveat. For the most part, any trend line that you can draw from this March low has been broken. Now, that's not the end of the world, because we can draw a trend line here, here's a trend break. We can draw a trend line here, we get a trend break. And we can draw a trend line here, and we get a trend break. But right now, we can't draw any trend line between this high and this low and have it bound price here. Doesn't mean we're dead in the water. It just means it looks a little bit different than some of these cases in the rearview mirror. What could correct that? The market moving to new highs. Then we could draw a trend line from here to here, and we'd have a new high here. So it's very, very correctable, but it hasn't been corrected yet. Also, this is like a fib here, but it has a time component on it. So even just this move in the S&P 500 from this May low to here, be totally normal to come back into this window here near the 200-day moving average, an upward sloping 200-day moving average in red. And guess what? That's right around that June low that we've been talking about. Here's a good example of not getting too freaked out about trend line breaks. If we draw a trend line from this March low where my cursor is to this high, then we've been below that trend line over here for several months. But as you can see, got extended from the 200-day moving average out here, and we've basically moved sideways for the most part and come back to this longer-term trend. Thus far, price has been making a series of higher lows above an upward sloping 200-day. If you're a stock market bull, you'd really like to see this area over here take on more of a look like this area here in November of last year. That's to be determined. But right now, we don't really have a serious bearish breakdown here either. Very, very similar concepts here from reference points. NASDAQ 100, that's the NDX, advanced decline line. This is based on issues. It has nothing to do with volume. It's going back to 2017. It is a weekly chart. Notice here, we have the Bollinger Bands, the center line here. We break below it. This is Q4 of 2018. Really, really bad things happen in the S&P 500 where my cursor is. During this bullish period, we stay above the center line on the Bollinger Band and eventually break below it here. COVID plunge, really, really bad things happen in the stock market. This rally, we've stayed above it since the March 2000 lows. And during this pullback, as of October 6th, it's a weekly chart, so we don't know what it's going to look like until after the close on Friday. But during the week this week, it was basically saying this doesn't look that much different than any of these pullbacks within the context of previous bullish trends. If this at the end of the week looks more like this or this, then we would learn something about probabilities. As of October 6th, if we're trading the chart in front of us, this checks try to leave it alone boxes. That's subject to change, but it hasn't changed yet. Also noteworthy, weight of the evidence. We just showed the present day looks better than Q4 of 2018 using breadth data. It looks better than Q1 of 2020 using breadth data. We've already shown from a trend perspective, it looks a lot better than Q1 of 2020 in the present day, and looks a lot better than Q4 of 2018. 33 days after the peak, the net aggregate opinion of all market participants is much more concerned in here than it is here, and it's much more concerned here than it is here. I've covered this chart many times. Compare the look over here, COVID plunge, to the present day. These are leveraged or high-risk loans. Do they look like they're concerned about a recession and default probabilities picking up? Thus far, the answer is no as of the close on October 7th. Also, if you check credit spreads, during the lowest low this week on October 4th, did they start to widen? No. This is what fear in the credit markets looks like. This is what increasing fear looks like. This is what it looked like after the close on October 4th. If we're trading the data in front of us, this data just doesn't look that bad. This is tech versus bonds during the session on October 7th. It doesn't really matter if we're showing this chart on the 7th or the 8th. It's the trend we're concerned about. And the recent trend is up. It's quite a bit different than tech versus bonds near the correction in 2010 and the correction in 2004. As noted on Twitter this week, when things were still looking pretty dicey, we had a bullish divergence in the stock-bond ratio. It's a similar look here. Notice in May, June, and July, price is down in the lower half of this orange box where my cursor's moving around here. Since then, a bunch of white space down here. This is different from this over here. Also noteworthy, here, we're never above the orange box. Here, we've spent several days above the orange box. And unlike the tech versus bond charts that rolled over in those two previous correction periods, 2004, 2010, we're making a series of higher lows, and that's even true during the month of September. Look how many times since the S&P 500 peaked. The S&P 500 peaks right in here somewhere. Look how many daily closes we get above this trend line. Every single one of them is above this trend line. Every single one of them is above an upward sloping 200-day. And we have several closes that are either in the top of the orange box or above the orange box. That really doesn't look anything like this concerning look here. Keep in mind, you can get false bullish breakouts. But remember, we're trading the chart in front of us. We're not trying to predict whether this breakout's going to hold or not. The longer it holds, the more relevant it becomes. Talked about 1995 in this week's video. You can pause your video player here, but here's something else that ties 2021 to 1995. In the previous cases, the return for the S&P 500 for the rest of the year, the median return was 4%. The average return was 2.3%. 86% of the cases were positive. Anything else that would tend to support the strong trend thesis? In a recent video, we covered this long-term breakout here on the right side of your screen. This data set entered this box in 1996, was in the same exact place recently, and now we've exceeded this high. This is a very long-term breakout. How about valuations? How about stocks versus bonds? Upper left-hand corner. Stock valuations are as cheap as ever relative to junk bonds. When you're up here, and that's where we are now, stocks are cheap. And that's relative to bonds. That aligns nicely with this stock bond chart that we've covered numerous times. It goes all the way back to 1990. You can see here in the year 2000, we roll over. We go below the 50-month moving average, and it rolls over. Similar situation after the peak in 2007. We roll over, break this trend, go through the 50-month moving average, and it rolls over. This look here and this look here really doesn't look anything like what's happening in the present day. Price below the moving average, it rolls over. Price below, it rolls over. Price above, the slope is up, and we look like we're trying to break out. And this rollover look here in the stock-bond ratio aligns with the demographics and the boomers. You can make an argument that this breakout and bullish look here aligns with the demographics favoring stocks over bonds. Really haven't seen anything to date to put the longer-term view in doubt. Pullbacks and corrections are 100% normal and to be expected. But from an intermediate-term perspective, the market still has some work to do. How do we handle that? The same way we always do. We head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.